Good evening. Good evening. Can you hear me? Hope would like to welcome you to our third financial literacy workshop featuring Miss Paulette Johnson. So at this time, I will give her the mic where she can give you a little bit about herself for the ones that has not been here before and update the ones that has. Thank you.
Thank you guys for coming on tonight. I see the crowd is kind of thinning out. Hopefully people are running late because the workshop that we're going to be discussing tonight is going to be on debt and managing that debt. And I'm going to share some interesting information with you about, especially for larger debts like mortgages, car loans, student loans, how you can reduce that interest that you pay and possibly pay them off sooner rather than later. So before we get started on that, I have one thing that I want to issue to one of our participants here tonight who has been really trying hard to stick with their plan. And so I was seeing that the Worthams haven't had pizza since the last workshop. So I got you guys a gift card to Cottage Inn Pizza for your efforts. No. So we'll get started tonight. We're going to be talking about, like I said, managing debt. But the first thing that we're going to do is I'm going to just kind of explain my business, Lifestyles Financial Coaching, to the new participants on tonight. It's a business that I started about 4 years ago to help people to gain financial stability, to teach them about financial literacy. And I do that by providing one-on-one workshops, one-on-one coaching sessions with people to help them to kind of narrow in on the main things that are their goals and their concerns. It's more of an individualized approach where I'm one-on-one with them and I'm helping them to reach some of their goals. Then I do workshops on money management, budgeting, debt elimination, and then talking about your credit score. So I do provide those services if anyone ever decide that you want more one-on-one coaching and assistance, that is available. I'm going to do a recap from last month's session where we talked about setting goals and budgeting. So last month we talked about goals, and that goals really are your roadmap to success. You know, when we think about a roadmap, we think about a destination where we want to be. We have a starting point, we have an ending point. And in between there, we will have to make detours, adjustments, and it's really no different than when you're working on goals. And then your budget, we talked about creating that budget. Everyone was given a budget worksheet to kind of give you some guidance on how to create your budget. Your budget is your blueprint. What a blueprint is just what people use to build something. And so your budget is your blueprint to teach you financial stability. It's so that you know where every dollar is going. Every dollar you got in, every dollar that you got out should have a name. It should serve a purpose. So if you have something in your budget and it doesn't have a name on it or it doesn't serve a purpose, then you have to identify that. You can't just leave it out there. And then when we talked about savings and creating that emergency fund, when you do that, it has a name on it. It serves a purpose. I provide you guys with a schedule on how to create a $500 emergency fund by the end of the year. So that is a SMART goal. It's specific, it's measurable, it's attainable, it's realistic, and it's timely. It is in the SMART goal. And so I'm going to ask you every time we meet, what do you want in life and what are you willing to do to obtain it? The Worthams showed that they mean business, so they didn't have pizza every Friday like they normally do. I was just telling them maybe to cut back, but they decided they just want to have it. So that's commendable. We're going to talk about homework. The results are in. We're going to follow the money. Because in your homework with your goals and your budget, You should have been able to identify how you're spending your money and what you're spending your money on. And then making adjustments is no different than your roadmap when you're trying to reach that final destination. Sometimes you can take a shortcut and sometimes you have to take the long way. And I find that most of the time when you're trying to get out of debt, sometimes you got to take the long way around. You can't try to do shortcuts because it will cost you. So one thing that I want to ask you guys is, what comes to mind when you think about debt? For me, it's anxiety. I don't like to have debt. Debt is a liability. Debt serves a deficit. It means that it's taken away as opposed to adding to. And then it also serves as an obligation that you have made to someone, whether it be to a creditor, to a family member, because when you borrow money from a family member, that too is considered debt, and you do have to repay that as well. So I thought that came to mind for me when I thought about debt. Debt stresses me out sometimes if it's if it gets out of hand. It gives me anxiety. It makes me feel, anxious, like I want to hurry up and get this taken care of. And so I want you guys to think about debt as, a lot of people say, my goal is to become debt free. Well, I want you to think about that more. Do we need to change?
Yeah.
Okay. Okay, are we good? Okay, so I want you guys to think more about debt. Becoming debt free is just a goal, because it's not the main goal. It's not the end game, because I have a nephew. He's 5. He's debt free, but you know what? He's also broke. So don't strive to become just debt free, because there are other things that should come along with that. And if you have a teenager, they're debt free, but you know what? They're broke. So we should not only strive to become debt free, but also have an extended plan to that. Think about what you're going to do when you become debt free. Because one thing that I've learned is, when you start to pay down debt, when that money free up, if you don't put a name on it, you're going to spend it on something else. And before you know it, months have gone by and you spent that money and you don't know what you spent it on, and you're thinking, man, why didn't I put that into a savings account? That was kind of one thing that I did when the first time I became debt free. Had all this extra money now, so I wasn't thinking, okay, now what's next? Because there's always a next. Once you meet one goal, then you got to already have a plan for what you're going to do next. Because if you're not prepared and you don't start thinking more long term, before you know it, you will have spent that money and you won't know what you spent it on, or, so it's good to just start thinking about that. So then here is a definition of what debt is. Debt is money that you owe for credit or a loan that's been extended that you are obligated to pay back. And so one thing that I also want us to be aware of and mindful of is that the important factor to your debt and your income is your debt to income ratio. That ratio is what lenders use to determine how much debt you can handle, or what percentage of your debt is being used from your income. So they just basically, what they do is they just take, add up all your monthly expenses for your debt, and then figure out what your total income is, your gross, and they divide that. And so it gives them a percentage of whether you, what percentage amount you have that you have tied in debt. And so there is something in your packet called Digging Your Way Out of Debt. And that is an exercise that you can do for yourself to determine what your own debt to income ratio is. And then at the bottom, it kind of gives you a guide to what that means. What your percentage is and where you fall. One percentage that I know lenders will use when giving a mortgage loan is if your debt to income ratio is higher than 43%, they typically won't give you the loan, because they want to make sure that debt to income ratio tells them how much debt you're carrying and whether you can handle more based upon what you already have. So in this example that I have, I just took the basics because there are 3 debts that I really believe we most of the time can't escape, and that's mortgage, car, and student loans. You can escape a student loan if you want to, but if you want to further your education, sometimes you have to do that. And so in this example, this person has a mortgage payment of $1,200 a month, their car payment is $400, and their student loan is of $150. So the total monthly debt is $1,750. Their monthly gross income is $4,100. That equates to about $49,000. So in this example, with them having a total debt of $1,750 and an income of $4,100, their debt to income ratio is 43%, because I just simply took their total debt and divided it by what their total gross income was for the month. And so that's all you have to do. Is simple. That sheet will help you to figure out what your debt to income ratio is. I would highly recommend, if you're ever going to go for a loan, that you do this so you know where you stand, and that you also pay down debt if you can, especially for a mortgage, because most of the time when you go in for a mortgage, it's like they take a snapshot of where you currently are with your debt versus your income, and then they calculate your debt to income ratio to determine whether you can afford the mortgage payment that you're asking for. And so if you have extra money to pay down some debt before you apply, it's gonna better your chances to get that loan that you're seeking. And then you also just wanna make sure that you're pulling your credit report annually, that you're reviewing it, because even if you're not seeking out to get any more credit, if you have fraud on your credit report, you won't know it. And anytime before you go to apply for a new loan, you should always check your credit report to make sure that there's no surprises, if there is something there that you need to fix, or if you need to explain something. It's better to be proactive than to get there and then they start asking you questions that you can't answer. So there's really basically 3 types of debt: secured, unsecured, and revolving. So the secured debt is where you have collateral to put down for your loan, and that just kind of guarantees the lender that you're going to repay the loan. And typically a secured loan is like a car loan or a boat loan, or something that you can use as collateral. Then you have your unsecured debt, which is more of a risk for the lender. And that's where you don't have any collateral. You have nothing to put down. The only thing you have is your word and promising that you're going to repay the loan. And that typically would fall under credit cards: Visa, MasterCard, Discover, American Express, a department store. Any type of credit card is going to be unsecured. The thing that you do want to stay away from, and I try to get teenagers to understand this, or young adults, don't go for those credit cards where you have to put $200 down to be able to get a $200 balance. Those things, it really defeats the purpose. One thing that I did when my son was younger is, as I was building my credit, I added him as an authorized user to my account. So then that way, as when he got older, he had credit established. I didn't let him use the card because he probably would have lost his mind, and then I would have had to hurt him. But that was just a good way to help him build credit and obtain some sort of a credit score. And then you have your revolving debt, where the lender's going to give you a maximum amount that they're going to limit you to spend, that will continue to keep revolving. As you spend it and pay it down, that balance, that credit limit is still there for you. That falls under the credit card, line of credit. I typically, department store cards, I typically try to tell people to stay away from those because it's just a way to keep you trapped, because they give you $5,000, you know, and then before you know it, you've gone and you know, charged up some things, and then that interest rate is so high that if you just make the minimum monthly payments, you're going to be paying for that merchandise 2 times over. So it's better to try to think about the things that you want to have, especially large purchases. One term that I try to get people to understand is delayed gratification. You delay one good for a greater good. So if you know you have this large purchase that you want and it's going to cost you a few $1,000s, you're going to forego doing some of the little things like going out to eat and going shopping and, you know, the little things that add up. You're going to forego that, and every time you would go out to eat, put that money in a savings account. So then when it's time, when you're ready to make that purchase, you got the money already to cover that. And so you don't have to take out a loan, or you don't have to borrow, or you don't have to use a credit card, because you've planned for it, you saved for it, you know, you've thought more about it. The one thing that I kind of emphasized before, where I think about good debt versus bad debt, and really, although there is no good debt, but if you have to put it in perspective, I listed here what I would consider to be debt that could add value or benefit to your life, because most of us can't afford to pay cash for a house. So we need to take out a loan. Plus, that's going to add value. That's considered an asset. That's something you will own, and it's going to gain equity. So you're going to have more, the home is going to be worth more than what you paid for it. So I kind of look at debt in that way, and that from that perspective is that if it's going to add value or benefit to my life, then I will sacrifice to do that. And the 3 here, a car loan, student loan, and I guess you could forego a car loan. You could pay cash for a car, but you probably, you know, it may not be the most reliable transportation unless you know, just save for years to get what you really want. So although, like I have on here on the slide, although no debt is considered good, the good debt that I've indicated here is normal debt that would add value or benefit your life in some way, shape, or form. The ones that I would advise people to stay away from: credit cards, department stores, payday loans, personal loans, things to that effect. Mr. Doug, you have a question?
I have a question on the prior slide. Is there a difference in the reporting to the credit bureau that's secured, unsecured, and revolving? When they report, when you have all credit, are they reported the same? Are they weighted the same as far as interpreting your ability to improve your credit?
Well, they are reported as secured, unsecured, and revolving. When you look at your credit report, it will say what type of loan it is. If it's a credit card, it's going to automatically say it's a revolving. So when you look at your credit report, it will say, if it's a revolving, it will say that in your credit report. One thing I know that lenders look at is revolving credit. If you have a lot of revolving credit accounts, that is a red flag, because then that means you've got 5 or 6 cards, and let's say you got $5,000 on each one, then that gives you $25,000 to $30,000 that you can have access to. And we will talk about that in our next seminar, where we talk about your credit utilization rate, because that also is important. The amount of credit that you have access to. Lenders look at that because they want to make sure that even though you're not using it, you have access to it, and they want to make sure that you're not overextending yourself. So they kind of help us out a little bit by, you know, not letting us go too far with our debt. But then on the other hand, sometimes they may extend more than we may be able to afford, because there's some hidden costs that we have that lenders don't know about. Because they're looking at your credit report, they don't know anything about your household expenses. They don't know anything about your lifestyle. So that's why it's important for us to know those things and make sure that we can afford it and we're not overextending ourselves. So that's just one thing that I kind of took away from when I started borrowing money, is that I noticed, they just look at the surface. But we know what's really down in the roots, and we really know what we're obligated to. And so we have to make sure that what we're asking for, that we can afford it. And here are some important factors that I think we should consider when talking about debt. And one thing that I think, if you don't remember anything else, remember that your debt takes away from your future earnings. That you are spending today, but it's taking away what you could have for the future. That was one thing. Once I realized, it just kind of was like one of those aha moments. It was like, man, this money I'm spending today is taken away from my retirement. Is it really necessary? And so then that's when I started to be more intentional about how I spent my money and thinking more purposeful about, what purpose does this serve? Am I just obtaining stuff? Because if I am, after a while you get bored with it, or you don't use it anymore and it's just collecting dust. One thing, just as I guess they say confession is good for the soul. Years ago, I used to, when I couldn't sleep at night, I would stay up and watch QVC. And so I would be up ordering stuff off of QVC in the middle of the night and get this stuff ordered, and then order stuff that needed to be put together, and then I can put it together. So then I would have to call one of my brothers and ask him, can you come over and put this together? And he'd put it together. He's like, why did you buy this? And I'm like, yeah, I'm going to use it. I bought a treadmill. I had a total gym. I mean, just all kinds of stuff. And he was like, you're not going to use that. He came over, and in the basement was the treadmill with stuff on it. And so I would call him up, hey man, I'm at the mall, I need you to come, and you got a truck, I need you, or I'm over here at the furniture store, I need you. And he's like, Paulette, are you really gonna use that? And I'm like, yeah. I told him, I said, I had a plan for that treadmill. I had a plan for that total gym, and neither one of them got used. And I ended up selling them for less money than what I paid, and then I paid interest on it. So it's like you learn from some of your mistakes and your bad habits, and that was one thing. I had to take the TV out of my bedroom because it was bad for me. It was like, okay, I can't sleep. What else is on at 3 a.m. besides QVC? So, yeah, so that's what I was doing. So I'm like, oh goodness, I got to get a handle on this. And so then we want to understand what our annual percentage rate is. What does that mean? It tells you how much it's going to cost for you to borrow that money. Your interest rate. A lot of people get annual percentage rate and interest rate confused. They think they're one and the same, but they're not. Your interest rate is used to calculate your daily interest, the interest that you pay every day based upon 365 days a year. So when you make your payments, they calculate from one time to the next. When you make your payment, how many days in between there, and that's how they calculate how much interest you're going to pay from one payment to the next. And then that compound interest is interest that's charged on the original balance plus the interest you accrued. So you really want to make sure you're gaining compound interest on a savings. You don't want to have your interest compounding on a debt, because it makes it harder for you to get out of debt, especially if you're only making the minimum payment. And then one thing that I learned that is kind of like, I think is beneficial when you have credit card debt, is that you want to make sure you pay off your credit card before the statement closing date. So if you make a charge and you're planning to pay it off by the end of the month, know when your statement closing date is, because that date is important, because that's when lenders report that on your credit report. So if I make a charge today and I pay it off next week, but my statement closing date is thereafter, it won't even show up on my credit report, because the lender is not going to report it until my statement closing date. interest doesn't start to accrue until it's due. So if you pay it off before the statement closing date, you're foregoing the information being reported to the credit bureau and not paying any interest on it. So that's kind of like a little trick that I learned. It's like, okay, if I need to charge, or if I want to charge something, like I like to have credit cards to be able to make online purchases, travel expenses, things to that effect, because today with the way fraud is, I don't want anyone to be able to have access to my money. If I'm going to have fraud, I'd rather have it on my credit card where it's not impacting my money. Then I can resolve it later. Mr. Doug?
If you pay it off before the statement date, how does that help your credit report or your overall credit history if it doesn't report to the credit bureau?
Well, for one, it doesn't show that you are carrying the debt, and you're not paying any interest on it. So here's a perfect example of how this would be beneficial. You already have good credit. You're just using the credit cards as a means to make purchases that you don't want to use with your debit card. So, and especially like now I'm getting ready to buy a house again. I don't want that stuff to hit my credit report because I'm in the process of buying a house. So if that hits my credit report, they're going to be like, oh, she out there racking up more debt. Hold up. We might want to consider whether we want to approve her application, because when we pulled it on day one, this is how much debt she had. Then when we pulled it on day, 2-3 months down the line, now she's got more debt. But if I charge something and then pay it off before the statement closing date, it won't ever touch my credit report. You will still have, your credit report is still going to reflect that you make your payments on time. It's just not going to show that you're using that credit to, so that they can calculate your credit utilization rate. And what the credit utilization rate means is the amount of credit that you're using based upon your limit. So they would say, let's say you have, $1,000 credit limit, and you use $500 of that. Your credit utilization rate is going to be 50% because you've used 50% of that, what you have available. That affects your credit score.
Why not just use your debit card? You don't pay off anything you buy during the month. Why not just use your debit card?
Because if I make an online purchase, I don't want to use my debit card.
You're saying security.
For security purposes, I would use my credit card, because if is there any fraud that occurs after the fact, I don't want my money to be affected. I'd rather it to be my credit card where it's more secured, it's protected, and I won't be liable. But if it's my debit card, then I got to go to the bank and dispute it, wait for them to reimburse me. In the meantime, it's messing with my money. And so I need to have more control over my money. Not to say that I'm not going to have control over the creditor's money, but I want to have total control over my money. I don't want anyone else to be able to come in and take from that. Does that kind of answer your question?
Kind of. I'm a little confused on it. I mean, because usually a purchase, I'm just looking at it, if you're not trying to build your credit, if you make a purchase, it's going to be within your ability to repay it. So $100 or $200. So your liability, it would seem to me, would be very limited.
But I'm not talking about a small purchase. I'm saying, like, if you're traveling, what I just said earlier, if you're traveling, if you're paying for a hotel, those are the things that I personally would use my credit card for. And then I would pay it off before my statement closing date. Because I'm not concerned with the impact that it will make of the information once it's showing up on my report that I used $200. I don't want them to see that. I want them to be able to see that I'm making my payments on time, because that also affects my credit score. And so that's what I'm saying. For security purposes, I use my credit card for larger purchases like travel, hotel, car rentals. We all know the mishaps that you can have with car rentals, and I would not want to have my debit card tied up in that mess. So yeah, that's what I mean for clarification, for the larger purchases or for the purchases where I want to have more protection. And so once we talk about tackling our debt, the first thing that we want to do, and there is 2 worksheets in your packet that gives you a plan, and you can decide which plan you want to use, whether you're going to use the debt snowball or the avalanche. But you need to write down all your debt. In the debt snowball, you're going to put it in one way, and the avalanche, you're going to put it in another. Once you complete that debt elimination worksheet plan, you want to make sure you continue to track your progress. Don't lose sight of the plan once you start paying off debt. Continue, see it through, stick with it until you have reached the goal that you've set for yourself. And so some things that I have done in the past, or that I do currently, is sometimes I split my payments up bi-weekly. If you have, like a car payment or a mortgage loan, you can just take out of your paycheck half of that loan. And if you want to pay it, fine. Most mortgage loans are set up on an automatic withdrawal, and they will only do it once a month. But there is a way that you can get around that, where you can pay extra money on your mortgage to save on interest and to cut some years off of your mortgage term. And then make extra payments on your mortgage to shorten the term and to pay less interest. You would be surprised how much paying an extra $100 a month would do for a 30-year loan. And so I do have a couple of examples that I did. How many homeowners do we have here? Because I want you guys to see this example that I printed. What I did is I filled this out with a $150,000 term. You and Mark will have to share. And then I said the loan was 30 years. The annual percentage rate I chose was 5%. And I put $100 extra would be paid each month on this loan. And so in looking at this, if you look on page 3 and 4, no, basically on page 3, it tells you how much you can save. Sorry I don't have enough for everyone. I'm going to give one to the Williamses. You'll see how much money you can save by putting an extra $100 down on your mortgage on page 3. If you just do the current plus the extra, you can save $62,000 on a $150,000 loan of interest that you would end up paying. And you would pay it off instead of, you'll eliminate 77 payments. And then if you do the biweekly plus extra, you would eliminate 116 payments. Oops. And you would save $55,000. So it just goes to show that making a little bit, even though we may not view it as a little, but an extra $100 a month over a 30-year term loan is substantial savings. And you can even do something like this with the car loan. You can pay extra on a car loan and the same thing will happen. But one thing that I would say is if you're paying extra on any type of loan, always ask them to apply it as a principal payment. Because what you want to do is you want to get the principal balance down as, faster so that you're paying less interest on that, because your interest is based upon your principal balance. So if you can put more money and get that principal balance down, then that's going to save you more money over the term of the loan and pay it off faster. Does anybody have any questions about that? Okay, so with the two plans that we have, the debt snowball and the avalanche, you have to decide which plan will work best for you. You guys know yourselves better than anyone. So here's what I know about the two plans. The debt snowball is really tailor-made for people who need to see quick results. That you don't want to spend a whole lot of time seeing progress because you won't stick with it. So I would suggest you do the debt snowball because it lists your balances from your credit debts from lowest balance to highest balance. And then as you pay off one account and move on to the next one, you just add the money that you used on the one you paid off to the next one. So then that way you see quicker results and it keeps you motivated and to stick with the plan. The avalanche plan is for people who saying, you know what, I don't really have to see quick results, but I want to be able to see that I'm saving more money. Then the avalanche plan is for that type of person that, you know, I don't care if it takes me a year to pay off that card. I just want to know that I'm saving more money in the process. And so that plan is going to tell you to take your highest interest rate to your smallest interest rate. And you're going to tackle the highest interest rate card first. And then you'll just keep going until you get down to, and this is not just for credit cards, this is for any type of debt. Credit cards, personal loans. I wouldn't suggest you put your mortgage or maybe even your car payment in there because those fall in a totally different category. And it's going to take you longer to pay. You already know your term for your mortgage is 30 years, so why even bother? And your car loan is more likely 5 years, and you know you're paying that. That's a consistent, it's a constant, it's fixed. And then the credit card debt or the personal loan debt has a higher interest rate. So you want to try to focus more on those and get those paid down. So those are the two plans that I would suggest you use and choose based upon your needs, what your objective is, what your goal is in doing this. And then I want you to think about after you pay your debt off, what's your plan? Put a name on that money. And so then that way you don't leave any room to be able to spend that money somewhere else. Because I think many of us, should really be thinking about retirement. How we're going to live, where we're going to live. Do we have enough in our, 401k or IRA to live? And if you don't, then now is the perfect time to start kind of trying to make up for that and think about those things. And so that's kind of where I'm at. I'm to the point where it's like, okay, I need to really start thinking about my future more. And even now with me purchasing another home, I was thinking, okay, this probably is going to be my forever home unless, the Lord bless me with a husband that's rich and, he take me away and we get a new house. But other than that, that's going to be my forever home. And I'm like, okay, what kind of things is important to me in making this purchase? One thing I hated when I owned my home before is I did not like mowing the grass. I did not like shoveling snow. So it was important to me to find a community where I wouldn't have to do that. And then another thing was a newer home. I didn't want an older home that was going to, nickel and dime me with repairs. Most of the time when I'm making decisions and how I'm spending my money, it's with purpose. I'm thinking more about how I'm going to utilize this. When I purchased my car, okay, my other car was older. I'm getting closer to retirement. I need to get something that's going to be good, reliable transportation, low maintenance. So that's kind of how I think. I don't really like to think about the now and get so caught up in things. I want to be able to, things have to make sense to me. And so that's what I want us to do when we are thinking about how we're spending our money. Make it make sense. Spend with purpose. Save with purpose. Don't save just to be saving. If you're saving, put a name on it. Decide already when you start to save what you're going to use that money for, because you'll find that it's easier to stick with a plan when you have a plan, and the plan should be written. So when you guys work on your debt elimination plan, write it down. Don't think in your mind, okay, I only got 3 credit cards, and so I'm just going to pay this one down, this one, this. No, write it down, because then also when you put it in writing, then you can see the progress that you're making. And once you can see the progress that you're making, you get motivated and you're more apt to stick with the plan. So on tonight, we're going to finish up a little bit early. You're going to complete your debt elimination worksheet, whether you choose the debt snowball or the avalanche. You can try them both out and see which one will work better for you. And then I did put the link in here for if you want to play around with your mortgage payment online, you can go in and put your mortgage information in and see where you fall. Kind of like the handout that I gave some of you, just go to this biweekly mortgage calculator thing and put all your information in and see how much money you would save, how much time you're going to knock off of your loan. And in this handout, it does have some tips on, if it's good to make a biweekly payment and what are some of the pros and cons of doing it. And then what to do if you can't do biweekly payments. It kind of gives you something to follow. Mr. Doug?
I don't know if you ever covered this, but my question is about stocks. Do you have any recommendation or any policy that recommend me if I to get in the stock market? And would you recommend, if you have, say, 3 rental incomes property, would you recommend saving that money, putting in a savings account, or investigating stocks?
With the rates for savings, I would not recommend putting it in a savings. I would recommend investing it. I would suggest you get with a good financial advisor that is more equipped to handle those types of things, that can give you their expertise on how you can invest that money and how it can grow. They can ask you the level of risk that you're willing to take, to give you some tips or suggestions on how to move forward with investing that money.
Like you being in business, do you have any recommendations offline you can give, or you don't?
No, because I don't deal with investments. I just deal with financial literacy, personal finance. I have to be very careful about making suggestions because I'm not licensed.
So how do you recommend the IRA and the annuity?
Um,
Part of your portfolio, and then you set aside some ad money?
I would recommend that, but I would recommend that you also, there's one thing you especially need to take into consideration when making investments is your age and how close you are to retirement. If you're already in, okay. Oh, okay. So if you're already in retirement, you should have a financial advisor that is able to give you guidance on how your money can continue to grow through retirement. If you're not in retirement, you should at least have an IRA, a 401k, a pension, or something. As I've stated before, you don't want to leave any money on the table. If your employer is matching dollars, try to take advantage of that as much as you can. Because one of the things that is also beneficial is when you file your income tax. You can also get a credit for the savings that you have for investing in a retirement. So I just think it's a win-win. If and people say they can't afford it, you can't afford not to. At this day and age, you need to make sure you are building something for your future. So I do have one other thing I want to do. I have a demonstration that I want to do about debt and how debt impacts us. So I need someone to volunteer to come up here. Thank you, Mr. Dana. Now, I'm gonna need you to hold a pole. Are you gonna be okay? I'm gonna need you to hold the pole and keep it steady. Okay, okay. It's not heavy at all. Okay, so I need you to stand up here.
You know I have like zero balance though, right?
Well, that's why I was wondering if maybe somebody else should do it, because I don't want you to fall.
I'll do it.
Okay, so come up here, and I want you to hold this pole like this. And it's not gonna be heavy. You just gotta hold it and kind of help it keep balanced.
Okay.
As I illustrate some things, I tried to find some things that can represent the type of debt that we carry. Okay. And so I'm gonna need you to move your hands closer. Yes, in. Okay. So this side of the pole represents our good debt. This is our car. This is our house. So as you can see, that debt is more lightweight because that debt is good debt. It's debt that adds value and benefit. And for some of us who have student loan, although the student loan debt has reached $1.5 trillion, it's not a totally good thing, but it's not a totally bad thing. So we're gonna add that to this side of the side. So now you see the pole is, it's not really moving, it's balanced out. So then we're gonna talk about credit card debt. And so when we do the credit card debt, we are going to see what the credit card debt does. Okay, now you gotta let it, yeah, just a little. Okay, so when we do that credit card debt, it kind of gets things off balance, and it adds more pressure. It's more like a weight on us. We start having chest pains and indigestion and can't sleep at night because we went out and spent more money than we could afford. Then, because we've spent more money than we can afford, now we gotta go take out a payday loan. So we add the payday loan. I need you to kind of help it along. We've taken out this payday loan now because we've overspent. And so now, when you look at this, balance this out, we are further away from paying off the things that add value because this is more out of reach now that we've overextended ourselves. And then when you look over on this side, it's weighing us down. It's weighing down your paycheck. It's weighing down your bonus. It's weighing down your tax refund. When you get that tax refund, now you got to pay back the payday loan. Then you got to start working on the credit card debt because we've overextended. So I just wanted to kind of do that illustration to show you that how debt can impact you. And so if Mr. Dana was to stand here for an extended period of time with this weight, eventually his shoulders gonna start getting tense and he's gonna start wobbling, he's gonna get tired, his knees are gonna start buckling. And that's the same thing that debt does to us, and we don't even realize it. Up at night, can't sleep, and then we overeat because we've spent too much money, so we're stressed and we're stress eating. So just think more about what debt does to you overall and how it really affects your life. And do you really need all that stuff? Does it serve a purpose? Is that going to add value or a benefit to your life and where you are now? Even if you're young, you can still think about those things because eventually it's going to catch up with you. So give Mr. Dana a hand. Thank you so much. So before we conclude on tonight, I do have a gift. So if Miss Beverly can pull a name, and hopefully it'll be someone that's here tonight. But before we end, does anybody have any questions? You and I already talked a lot. Mark Wortham. You get a gift card. No. You can take your wife to the movies. Look at me. Don't tell me y'all don't go to the movies. Well, y'all. We will. Okay. Sorry. I thought maybe. Yes. Yes. So, I want to thank you all for coming tonight, and hopefully this information has been beneficial for you and that it's kind of got you to thinking, because that really what it does for me is when I think about money, it's like I really get to thinking, and I'm like, okay, you know, I'm already thinking about how I'm going to, once I get my new home, how I'm going to split my payments up, and how, you know, I already got everything on a spreadsheet, what my expenses are going to be and everything. So that's just who I am. I'm a numbers person, and I like to be prepared. I like to be proactive. So if anyone doesn't have anything else, that would conclude our session for tonight.